So that is a systematic risk because it will be the risk for stock A and also for stock B and also for stock C. As long as you are in the stock market, you will have this risk, which is the risk of the stock market crash in the United States. So if let's say the interest rate increase, and then all the stocks, no matter you are A or B or C, you will face the risk of an interest rate increase because this interest rate affects everybody in the economy. So therefore, systematic risk is something that affects everybody. It's something that nobody can avoid. It's a systematic kind of risk that everybody will have to face it. And this systematic risk is a macro risk. So you can put there systematic risk bracket macro risk. Okay, so systematic risk. So here you put macro. So anything to do with economic data like CPI, interest rate, unemployment rate, GDP, inflation, CPI, all this as long as it is macroeconomic indicator, it will be, I think it's outside. Yeah, here, right? Our room, right? This is our room, right? Okay. So then anything to do with the macro or global financial crisis, global financial, GFC is global financial crisis. Global financial crisis, and these are all a blanket of risk that everybody will affect. Nobody can avoid. Okay, so this is a systematic risk that the company are facing. Now, what is unsystematic risk is something individual. So, for example, stock A has a competition problem. It cannot compete with their rival. So that's stock A's problem. So this random risk is happened to stock A only. Then let's say stock B. Stock B has a problem of the management problem. The management is very corrupted. So that's stock B problem. It's random risk that affects stock B only. Then stock C also have its own random problem. So each of these company, right, they also have their own problem. They're facing with two risks. One is that the problem of the whole world. The other problem is their own problem. So that's the unsystematic risk. So therefore, they are facing with systematic risk and unsystematic risk. So in portfolio management, right, we say that you can diversify away all these unsystematic risks because by adding more and more companies together, right, they can somehow neutralize each other. Because when the stock market is very well, some company will perform together with the stock market, but some company will go the opposite direction because of their own random risk. Okay, so therefore, if you put all these companies together, right, risk and the chemical reaction among them will somehow neutralize each other, and then you will bring down the overall risk. So this unsystematic risk is something that you can diversify away. By adding more and more stock into that portfolio, you can diversify away this unsystematic risk, which is the individual risk. Because you bring in one company, you bring another company, and then this company maybe is good for this kind of news, but then the other company is not good for the news. But still, when something happens, this company share price increase, but this company reduce. But overall, you neutralize each other. Okay, you will see your portfolio reduce by a lot because of this diversification. Now, what is something that you cannot be diversified away is a systematic risk, which is a macro risk. So this macro risk is something that you cannot be diversified away, no matter how much you manage to. Okay, because this thing happens to everybody. There's nothing you can do. Okay, it's a systematic risk that you cannot be diversified. So this individual firm risk will be individual like human resource problem, or you have a competitors problem, supplier problem, competitors, And then you have a suppliers. And then sometimes you have a raw material problems, like some of the manufacturing companies where their raw material is imported from, let's say, elsewhere, and then that raw material is expensive, and that will affect your cost of production. Okay, so that is your specifically to you only. Okay, so this kind of problem that affect you only. Okay. Okay. Now. So this is a diagram. The diagram whereby here is a standard of deviation. You know what is the standard deviation, right? By now, what is the standard deviation? Yes. Okay, standard deviation is the risk. And then here will be your firm specific risk. Here is your number of shares. Okay, N is your number of shares. N will be your number of shares. So as you add more and more shares into the portfolio, you can see that your risk is diminishing. Okay, you can see that your risk is diminishing. Okay, now for the market risk is only up to a point here. So as you add more and more shares into the portfolio, your unsystematic risk is being diversified away. But your market risk, which is a systematic risk, cannot be diversified away. So therefore, your standard of deviation, right? You still start in somewhere around here, let's say 0.5 or something like that. Okay. So no matter what, right? You still have a standard of deviation. You cannot diversify away all the risks because of the market risk that you cannot be diversified away. So in summary, systematic risk, okay, systematic risk can't be diversified. Can't be diversified. Okay, because if there's a next day, if there's a stock market crash, no matter where you put your asset all down, there's no way you can hide unless you put your asset into cash. Okay, so if as long as you are looking at equity, right, you can't hide away from it. Okay. Okay. Okay, so next, risk versus diversification. So same thing. Okay, so the number of stock increase, the standard of deviation reduce. Now, then let me ask you, given a portfolio, equity portfolio, right? What do you think in the real life the fund manager will hold in the portfolio? How many stocks that you think a fund manager will hold in the portfolio in the real life situation? How many? You make a guess. 30, 40? Good guess. How about the rest? Yeah. Actually, I talked to the PNB fund manager before. They told me it's about 40, 50. Minimum 40, 50. Thanks. Okay. So all of you sign already. Next week, then you sign both columns. Okay, this week you sign here. Okay. So actually, you need a lot of stock. Now, you know, in Malaysia, in Busan, Malaysia, we have 13 sectors. 13 sectors. Each of the sectors, they are different industry. So 13 sectors, banking, consumer, oil and gas, and all this. Now, out of these 13 sectors, right, it can't be you just pick one from each of the sector, then 13 stock. Cannot be. You must have a, well-diversified portfolio. So each of the sector, maybe you take like 3 to 5 stock. So in the end, you will end up holding a lot of stock. So therefore, in order to have a well-diversified portfolio, you must hold a lot of stock in it. Okay, and then you can diversify. So that means what? That means your return is compromised because you you diversify away your risk. So that means your return also compromised. Because sometimes when this thing happens, for example, when the stock market not performing, maybe the commodities are performing. So all the banking stock all go down, but then the plantation all go up. So at least you can cushion in that sense. Okay, so you need to diversify so that some sectors will go down, but certain sectors will go up. And then let's say last year, COVID. So when the COVID comes, what happened? All the company, all banking stock, everything down, right? But except which sector? The healthcare and which sector? And the technology, because everybody stay home and use computer. So the technology stock went up. So it didn't down all the 13 sectors. Only 2 sectors were doing very, very, very well, exceptionally well. Technology stock, the whole sector, right, index increased by, I think, 80%. And then the healthcare stock, which include the gloves, increased by 280% for last year. And then for last year, only 4 sectors have a positive return. So the third one is industrial. And then the fourth one is logistics. Okay, logistics. So there are only 4 sectors have a positive return last year. And the rest of the 13 sectors all down because it was a COVID year, pandemic, it was a recession. So when you are moving towards this year and next year, the economy is recovering. So which sector you think will go up? Most likely will be those consumer stock and maybe properties and construction maybe still got some time because all these sectors you need the government projects. If no project, no growth. So you look at all these, it's like they are individual news related. They are random. Okay, they have their own risk. So if this thing happen, then if this news happen to be advantage to this particular sector, then this particular sector will increase. So if you happen to own this share, because you well diversified, right? So if you happen to own this sector share, then you will benefit. Okay, so although your other sectors not performing, but this return can help to cushion out the overall portfolio return. So that's the purpose of diversification. You need to diversify, put your money into various places so that you can overall balance your return, okay, risk and return. Okay. Now, this one is called the covariance, correlation, and portfolio risk. Portfolio risk depends on the covariance between the returns of asset, expected return on 2 sector portfolio. Now, for tutorial questions number 6B, right? 6B, you're supposed to calculate the risk, the return, the expected return and the standard deviation of the portfolio. And that portfolio only have 1 risky asset and 1 risk-free asset. Okay, that's tutorial question number 6. Now, in this case, right, this is talking about 2 securities. That means stock A and stock B. Okay, it's not like one stock A and then the other one is FD. It's different. Okay, I explain again. In your tutorial question 6, we have a portfolio. And the portfolio has 1 stock and then followed by 1 risk-free asset. And the risk-free asset is like your FD, whereby you put your money in the FD. The risk is what? The risk is got any risk or not? No, 0 risk. If you put your money in the FD, 0 risk. So any variance there, any standard deviation there. So the standard of deviation for the portfolio for tutorial 6, right, is just the stock only times the weighting of the stock. That's it. Okay, you don't add into the risk-free asset risk because the risk-free asset is 0. But if let's say in coming to this chapter, we are looking at 2 risky assets in the portfolio. 2 risky assets. So therefore, you need to calculate the standard deviation differently. Okay, so the expected return is still the same formula, same, which is the weighting 1 times the R1 plus weighting 2 times the R2. The expected return is still the same, but the standard of deviation is different. So this is a covariance calculation, whereby covariance of A and B, right? Stock A and stock B, you are looking at the the variance, okay, the variance times the variance, which is you see stock A minus stock B, okay, expected return of stock A minus stock B, RS minus expected return of RS, okay, and then RB minus expected return of RB. So in the sense is that you have the variance of stock A, and then you have the variance of stock B. The difference of stock A, the variance of stock A, and the variance of stock B, you multiply them together. Okay, so then this one is called the covariance. So it's talking about the relationship between these two stocks. So for example, in a normal situation, right, if stock A appreciate, okay, increase in the stock price, then what happened to stock B? So if let's say stock A increased by 10%, stock B also increased by 10%. So can we say that this stock A and stock B has a positive relationship? Yes. So if let's say I say that stock A increased by 10%, stock B increased by 20%, can we say that this positive relationship is that this stock B is a 2 times the relationship of stock A? 2 times. Okay. So therefore, this covariance and correlation, right, is talking about the relationship. Okay, particularly the covariance. It's talking about the relationship of the stock. So when you have another stock C, when the stock A increased by 10%, stock C reduced by 10%, minus 10%. So can we say that their covariance is negative? Yes, it's negative. Okay, then, so the formula for the covariance is this. Now, if you want to use the Excel worksheet, right, you can use the Excel worksheet as in COV.S, and then you highlight the whole thing. That's it. You can get the answer, which is COV.S. Okay, COV.S. And then you bracket, and then you highlight, and then you close bracket, and then you get the covariance. Okay, you have to highlight 2 rows. One is row for the stock A, and then one is for the stock B. Okay, so you got to highlight 2 rows. So in fact, that 2 rows, in fact, is looking at the I think the variance of the 2. Okay, the variance. And the correlation is based on the covariance. So the correlation is the answer for the covariance divided by standard deviation of stock A times the standard deviation of stock B. Okay. So okay, later on I'll show you. So I just talk about the formula first. So this is a formula, and then the correlation is this. Okay, the concept between this and this, what's the difference? Now, the difference is that just now I said stock A increase and stock B increase, and then I said stock A increase, stock C reduce. So I know A and B have a positive relationship, and then A and C has a negative relationship. Okay, so this positive and negative relationship, right, is just covariance only. So covariance is a very superficial kind of a ratio that tells you the relationship, either positive or negative. However, the correlation, right, is the one that determines 2 times or 3 times or 5 times more, that kind of a relationship. Remember just now I showed you that the other one is 2 times more than the other one. So I can specify that this relationship is what kind of relationship? Is it like a very strong relationship, like 2 times or 3 times kind of relationship, or 0.2, 0.3, that kind of a relationship? So for correlation, right, it tells you the strength of the relationship. Okay, so for correlation, it tells you the strength. Yeah, the beta. The beta is a market risk. You compare the individual stock to the market risk. Stock to stock is this, yes, but the formula can be the same. You just, because instead of stock B, right, you put the KLCI index here. You put 1 row of stock A, and then 1 row of KLCI index. Then you calculate the covariance and correlation will be the beta. Okay, now Then this one is the strength. Okay, the strength like gives you the strength of the relationship. So you can tell that between the stocks, right? Stock A and stock B, what is their relationship? Some stock is a positive 1.2. Some stocks are positive 2.3. And then some stocks are positive 40 times. Okay, this kind of relationship. So you can see that, oh, wow, this particular stock is very volatile. And then some stock is a negative, okay? So I usually like to look for what? Look for negative one. I like to look for the relationship with the negative one so that I want to add into my portfolio so that I want to reduce my overall risk. Okay, if everybody have a positive relationship, then the market go up and go down together. So if I have some negative insight, at least I can, you know, neutralize each other. So I prefer to have that. Otherwise, my portfolio is very risky according to the market trend. Hedging will be another thing. Hedging meaning that you are actually short. That means in normal situation you long, right? Buy low, sell high. But the other part is that you are hedging, you are selling also. So that means you are hedged. So in the sense is that by theory, right? If you long and then you short, your return shouldn't be too high because you long and then if the market goes down, right? Either one of the position will lose money one. No, whether you go up or you go down, either one position will lose money. Yeah, anything will lose. But then if you are in a long and a short position, right, your portfolio, your return is kept in a narrow way. So unless you can manage well, like when one trend you go up, you sell it, then the other trend go down, you sell, then you gain both ways. Then you can make a lot of money. So you need to manage that. So okay. Then next we come to the figure here. Now, this one talk about four scenario. You have severe recession, mild recession, normal recession, normal growth, and then boom. Okay, 3 scenario and then 3 probability here. So all these 4 probability will add up to 10. Yeah, add up to 100%. And then this is the rate of returns given. All these are given. The blue colors are given. So let's say for a severe recession, you put a negative 37% return. For mild recession, you put a negative 11. And then for normal, it's 14. And then for boom, it's 30. Okay, so these are given. And the stock, this is a stock. And then this is a bond. So then to calculate the return for the stock will be, you have to use this times this. Okay, so you get this figure. So each of the scenario, you multiply by the probability. Just like tutorial question number 6, you multiply the probability. So in this case, you add up all up together, and then this one will become your expected risk for this particular stock. If you have 1 quarter, 1 quarter, 1 quarter, 1 quarter, you just add these together divided by 4. If you have 1 quarter, 1 quarter, 1 quarter, 1 quarter, you just add all these together divided by 4. But in this case, you don't have same probability, right? So we cannot do exactly the same as the previous tutorial question. We have to times the probability, each one, times the probability. Okay. Then the bond fund also like that. The rate of return times the probability. And then you get your answer. So this is the expected return for the bond, and then this is expected return for the stock. Okay. So then calculating using the tutorial 6 question method, right? You calculate the mean, the variance, and the standard deviation. So once you calculate the expected return, and that become your mean. Okay, so your mean. Then after you calculate the mean, straight away you can calculate the variance and the standard deviation straight away. Okay, from your either from your calculator or from the Excel worksheet. So if it's from the Excel worksheet, you have to use the word variance dot s, variance dot s, and then bracket, you highlight the return. Where's the return? I highlight the return here. Wait, the return is where? Is it here? The return for the stock. Here. Okay, you highlight here. The return of the stock. But you need to multiply the probability first. So you need to have another column whereby you multiply the probability and then you highlight that. And that will be your variance. Okay, you need to multiply the probability. You cannot just simply multiply this one. Okay, you need to multiply these two together. You need to take into consideration of the probability, given that this question has a probability. Now, some questions, normal questions, they don't have a probability scenario. Like your assignment, no probability, because your assignment question is a normal case scenario. Normal case meaning that you assume that in a normal situation, okay, not like this one. This one will give you 3, 4 scenario. Okay. So this one is the formula, and then the standard of deviation will be the square root. Okay. Will be the square root of the variance. Okay. Which one? This one, expected return. This one is the stock deviation from the expected return. Given, because the blue color usually is given. Wait, no, usually you can find from here. If you to key in the 0.05 times the minus 37, you give another column here. What's the figure? 0.05 times minus 37. Huh? You give me another column here. 1 point minus 85. Okay, then this one, you need to calculate the minus 2.75. Okay, minus 2.75. Then the other one is 5.6. Okay, then the other one 9. Okay, can you calculate the mean? Huh? 2 point. Then can you minus the 2.5 here? Minus. Then minus. Then you square them. Uh, 1.85 times 2.5 okay, minus 1.85 minus 2.5, 4.35 times 4.35. The first one is 18.922. Then this one is 2.75, 2.5, 27.56, correct? So the answer, this one, 1.61 or 9.61. Then this one, 20, 22, 22, 42, 42 point. Okay. Then you add them all up together and then you square root. So you should get this one. You should get 18 point something. What's the answer? Will be 2.25. Can you square root 98 and see what's the answer? 98, right? Where's my square root? Oh shit. $9.8. No, 9.8. Okay. Okay, so you're supposed to you need to calculate again using an Excel worksheet and see whether maybe it's the calculation here is wrong. Expected return. Expected return. Deviation from the expected return. Okay, wait. The rate of return. What is the expected mean first? 2.5, is it? 37, 2.5, 39. I think your expected return you calculated wrongly already just now. You need to calculate again the expected return. Maybe I just, okay, you help me to look at the figure, take photo, and then I use my Excel worksheet. Okay. 0 point, the first one is 0 point what? Huh? 0.5. Then negative. I mean the probability. Or you mean this one? Then 0.25, 0.4, 0.3. Okay. Then this one is negative. Then the next one, negative 11, 33. Huh? Oh, correct or not? Then this one is equal to this one to the times this one. Okay, so I highlight. Then I calculate the mean. Okay, so the mean is equal to average bracket (2.5). The variance wait. Yeah. Okay, then the variance Okay, then this one is the equal to this one to the power of 0.5. 5.72 different. What's that? The other one. 32 variance is 32. Okay, let's see. The deviation from the expected return. Square deviation. The rate of return. Why they want to put minus 47? Okay, but anyway, I think we'll come back to here. I'll check the textbook. Sometimes it's the slide, they have a error, printing error. So I'll come back to here. We will move on first, okay? I want to move on. Okay. Sometimes it's a slide, there's a problem. I need to refer back to the textbook. Okay, but anyway, we move on to portfolio risk with two assets. So now, if you look at this portfolio, right, the expected return is this formula. So this formula is nothing new. You just take the weighting times each of the expected return for the stock. So weight 1 times stock 1 plus weight 2 times stock 2 plus weight 3 times stock 3, and then the rest go on. Okay, so that's the expected return, nothing new. But it is this variance that is something new. Okay, you see that this variance formula is weight 1 times standard deviation of 1, and then the whole thing square, plus weight 2 times the standard deviation of 2, and then the whole thing square, plus 2 times this weight 1, standard deviation of 1 times weight 2, standard deviation of 2, times the covariance of stock 1 and stock 2. This thing is the called covariance. Okay, and the covariance, just now the formula was given. Okay, the covariance formula was given just now. Okay, which is you're looking at the variance of A times the variance of B, and then I think square root or something. Okay, you refer back to the formula. Okay, come to this. This is the one that I want to show the Excel worksheet. Okay, we come to this. You're given this situation. You have stock A, which is a stock, and then the other one is a bond. You have one stock called the stock return, and the other one is the bond return. So these two are considered risky, okay, because bond also risky. Okay, so you have stock A and then bond A here, stock and bond. So this is given. The blue color is given. So you have 10% and then 5%, 10%, all this. So all these are given. So what you're supposed to calculate is all this. So you're supposed to calculate this. Okay. So now you look at the return. So for stock, it's 10%. For the bond, it's 5%. For the standard of deviation is 19. Okay, so this is that means given to you. Standard of deviation is 19. And then the standard of deviation for the bond is 8. And then, so I think just now was given. So this is given. So all these are given. So I believe this is given because they didn't give us the historical data. They just give us one figure. So there's no way we can calculate the historical data. So therefore, these figures are all given. Okay, so all the blue color ones are given. So this minus 47 are all given. So then you're supposed to square it. Okay, but anyway, I'll come back to here. Okay, anyway, we come to here. So the standard deviation is given. All these standard deviation is given because in order to calculate the standard deviation, you need the historical data. So over here, they didn't give us a historical data, so we can't calculate. Okay, so it is given. So presumably they calculated and then they give us this figure. And then the covariance also given. Okay, covariance is given. So we are supposed to calculate the portfolio, stock A and stock B, this portfolio. And then this is the weighting. The weighting is that I can have 1.2, because Actually, a normal situation is that you have up to 100%. Okay, but in this case, 1.2 meaning that you got money from elsewhere. Okay, so in this case, you borrow money from the stock A here and then to add on to the stock B here. So that's why you have 1.2 over there. The other one is minus 0.2. So it is borrow money. Okay, so in this case, whenever you see a negative, meaning that you are borrowing money. So you borrow from the stock A and then you add on to stock B. So that's why you have 1.2 as weighting. So then we change the weightings here. So from 1.2, then we reduce to 1.1, and then we reduce to 1. 1 meaning that 100% into the bond, and then 0 into equity. So then we have this 0.9098. Okay, so this figure is given. Okay, so that means when you use 0.9, then the other one will be 1 minus 0.9 is give you this one. Okay, the other one is always 1 minus the weighting of the other one, because you only have 2 stock. You get what I mean? You have 100% fund. The other one is 40%. The other weighting is 60%. The other one is 30%, 70%. So it's always 1 minus the other one. Okay, so then you have this weighting. So then you come up with all this weighting, and then you're supposed to calculate the expected return. Okay. So let's calculate. Okay. So what I want you to do is looking at the Excel worksheet that I gave you. Looking at the Excel worksheet that I gave you, right? Okay. You copy the heading first. You copy the heading, and then we come to this page here. You copy the heading. We open up and then we copy the heading. Okay, if you are not familiar, you go back to here and see. Okay, so over here, I take away the 0.9 something because I think that one is not important. So I take out. So I just have a very clean data. So over here, the weighting will be 1.2. Okay, I start with 1.2, and then the formula here will be equal to 1 minus this one, enter. Okay, so I have 1.1, 1.0, 0.9, 0.8. If you have the Excel worksheet, you follow me. I'm reducing 0.1 as I go along. 0.7, 0.6, 0.5, 0.4, 0.3, 0.2, 0.1, 0, minus 0.1, minus 0.2. Okay, so this one is a weighting. I established a weighting here. Then for this weighting is 1 minus the other one. So I just drag the formula down. So I can make the data more clean. So I go to the here. I can make it 2 decimal place. So it's very clean here. Okay. So this is the weighting. So what we are going to see is that I'm going to allocate my portfolio because I have the money. Let's say I have 10K. I want to allocate my portfolio. So I can say that, okay, I want to allocate 100%, 100% into in here, 100% into bond, and then 0 into equity. Okay, I can do like that. Or I can say that 100% into bond, equity, and then 0 into bond. So these are the combination of asset allocation. Okay, that means I can allocate the money. I can have 10% stock A, 90% stock B, and then 20% stock A, 80%. You know, all these are possible allocation. All these are possible. It's it's borrow money. That means you borrow. You see, yeah. So if let's say you have the stock here, you can borrow from your margin. It's called margin financing. So if let's say you open a trading account, right? You can borrow money from the trading account. They give you the financial leverage lah. So you have to pay interest lah. So then you borrow like 10K or whatever, then you buy the other one. You can do that. So it's called borrowing. Okay, when you have minus. So this one also, you borrow from this part and then you add more into it. So whenever you have more than one, that means you are borrowing money. Okay. Now, so then the next one is using the expected return. Okay. So given that you have this probability or this asset allocation, so the expected return will be equal to your weighting times your return. Remember, your weighting times your return. So I put equal. My return is what? Is 10. 10 is the return for the stock. And then 5 is the return for the bond. Okay. So I put 10. I click here 10. I multiply the weighting. I multiply this weighting. Okay. I bracket them. Now, remember this one is fixed here already, right? So I need to put a dollar sign here in order to fix it. Do you know why I put a dollar sign? To fix it there. Fix the 10 there. I put a dollar sign. You know the dollar sign, the function of dollar sign is to have that location only. So when I go through the formula, right, I'm going to use this fixed figure times the rest of the figure here. So I'm going to fix at 10 here. Okay, so I use the dollar sign for this particular cell. Okay, you understand? This one is very important. Otherwise, when you do your Excel worksheet, you don't know how to do already. Okay, so this is basic Excel worksheet formula. So you put the dollar sign is to fix this return. The return you already know is there, so you're going to use that return. Then the weighting, and then plus open bracket 5% times this column here, and then you close bracket. Now then you have to put a dollar sign here as well. So this return 5% is fixed already. And then you press enter. Do you get 4? Then you drag down. So therefore, this one will be your expected return for the portfolio, stock A plus stock B, with the changing weighting. The return of stock A plus the return of stock B with varying weightings. You see, I'm calculating the expected return of this portfolio that has stock A and stock B. So the return of my portfolio depending on the weighting that I have for each of them. So if I put 100% into equity, right? Of course, if I borrow money and put more money into equity, of course I get higher return. The more money I put into equity, the higher return I get, because stock can give higher return. Okay, so for those of you who didn't get, you check with your neighbor. Okay. The standard deviation is a long formula. Weight 1 times standard deviation of 1 plus weight 2 times standard deviation of 2 plus 2 weight 1, weight 2 covariance times covariance. It's a long formula. So, okay, we do slowly. Equal to, okay, I want to see the formula again. I can't remember the formula. The formula, equal to square, okay. Equal to bracket weight 1 times the standard of deviation. Where is the standard of deviation? Here. Yeah, the standard of deviation, I usually bracket first before I log. I bracket first. Bracket, then only I log it. I go back there and then I log it. Okay. Weight 1 times the standard of deviation of 1, the whole thing square. To the power, you know how to do to the power? The arrow, the pointing triangle arrow to the power of 2. How to increase it? I cannot increase the zoom up. I cannot increase it. Can't increase it. But can you see or not? It's that to the power it means triangle up like that. Then I keep forgetting the formula. I'll go back there and see. Okay. Weight 1 square times weight 2 square plus this one okay, it's weight 1 square times weight 2 square plus I see. Okay. So it's weight 1. Okay, wait, I do all over again, sorry. The formula is too long, so I have to I cannot remember. Okay, equal to weight square okay times this one square. Okay, will be dollar sign. Okay, so will be weight 1 square times the standard deviation square. Okay, let me see the formula. Okay. Oh yeah, they use the weight 1 times the standard deviation and then they square it. But then when I use that, I also get the answer. Okay, so if I were to use that formula, okay, see whether you get the answer or not. If you use the book 1, weight 1 times standard deviation of 1 to the power of 2 plus weight 2 times to the standard deviation 2 plus 2 times 2 times this one times your this bracket times open bracket this one times this one close bracket, and then you multiply the covariance. Lastly, you multiply the covariance. So this covariance is a dollar sign. Then this one is a E4 and D4 is a dollar sign. Dollar, dollar. Then this one is dollar sign. Dollar sign and E. Dollar sign. Okay, so you press enter. Yeah, that's why when I do this one, right, I can find the answer by using my formula, which is I use this square and then times this square, and then you see I use this square times this square, and then plus. So if I split the square, right, I can get the answer. So I don't know why. But anyway, unless you want to counter, use your calculator and see whether the formula, if you use a calculator, if we can see whether you can find the formula. I mean, can see the result. Because initially I used this formula and then I got different answer. Then I used this and then I got it. Oh yeah, the whole thing, do you square root? Okay, the whole thing, do you square root? Square root 0.2. Also cannot. You see, when you square root, do you get it? This to the power of 2 plus this to the power of 2 plus 2ab times covariance. Correct what? This one is correct. 2ab. You try when you use the textbook one and then you square root, is it you get same as my answer? You square root or not? Square root. Because the variance you okay. So that means that means it's correct. Yeah. Correct. Because I to the power of 0.5, I use 0.2, so I keyed wrongly. So it's correct. Okay, you use whichever method is correct. Either you use the WB square sigma B square or WB sigma B bracket square, also get the same answer. Okay. So then you go down. Because this one is standard deviation, what? So you have to square it. Just now I put the square root as 0.2. That's why I didn't get it. Now I put 0.5, so I get it. E. Oh, I didn't lock something. You check whether I lock something or not. I think I didn't lock this one. Okay, so that's why this formula is very troublesome. Okay, so it's when you do this kind of question, right, you have to be very careful because all the numbers very a lot of formulas, so that's why you have to be very careful. Okay, it's like doing mathematics problem question like that. Okay, so then this one is the standard deviation. Now, so this is the standard of deviation that I got from the portfolio. Okay, so now I'm going to plot a diagram. So I'm going to plot a diagram whereby, okay, I want to see that the expected return is on the y-axis and then the standard of deviation is on the x-axis. So I want to see something like that. So when you plot a diagram like that, right? So if let's say the thing that you want to be happening on the x-axis, right? You have to put it in the right-hand side here. And then the return is on the y-axis, the y is here. So you have to put x figure here and then y figure here. So this is a standard deviation, which is x-axis. And then this one, the return is the y-axis. Correct? So far, okay or not? The standard deviation, I want to put it as the x-axis. And then this one, I want to put it as y-axis. So what I can do is that I copy this one. I copy the values only. This is a return. I copy the value and then I put in the left-hand side so that it will be appear on my y-axis. So I paste value only. Okay? Okay. So this is a return from here. I duplicate it. I put it here on the right-hand side. So this one will be the x value. This one will be the y value. Okay. So then I highlight this thing and then I put insert. Insert, you look for the diagram. You look for the diagram and then you click. Then you will get this diagram. So for those of you who have the Excel worksheet, you try. Otherwise, you try at home. You try at home, see whether you can get this or not. So you can always open up the worksheet and then you try yourself. You don't delete the first worksheet. Make sure you don't delete the first worksheet. The first worksheet is for you to see back. And then you can open up second worksheet, third worksheet to try, to practice. So then this one will be the efficient frontier for all the possible combination of the asset that you can invest. So with this combination, okay, with the weighting combination, right? This is the risk and return that you can get. Okay. Now, if you look at it, right? So this one is called the efficient frontier. Okay, it's called the efficient frontier. And then out of this efficient frontier, right? Can you tell me what is the risk and return for this particular end here? What is the risk and return? The risk will be here, 24, let's say. The return will be almost 12. So the risk and return for this will be 12 and then 20 something. And then the risk and return and this particular dot here will be 6. return, and then the standard deviation is about 7 or 8. So the higher you go on the right-hand side, the more risk it is, and then the higher return it is. So high risk, high return on the right-hand side. So on the left-hand side, it means what? Low risk, low return. So the risk and return trade-off, meaning the keyword here, risk and return trade-off. Okay, so the keyword is risk and return trade-off, meaning that the higher the risk, the more potential return that you have. Then if let's say you do not want the risk, then you will get a smaller risk, a smaller return. So if let's say I ask you to invest your money into Bitcoin, you want or not? Put all your money into Bitcoin. You don't want, right? So I said, okay, now you put because you don't want the risk. So then I said, okay, how about you put your money into the FD? Are you happy with the FD? You're happy. 2%, you're happy. So that's a trade-off. Because the trade-off meaning that if you do not want the kind of risk, then you will have to satisfy with your low risk return asset. Okay, so this trade-off meaning is that if you want to have high return, you must be able to take on that higher risk. So if let's say you're scared of losing money, then you better put your money in the FD and accept the low return and accept the low return, and then you don't put it in the FD and then you grumble and say, oh, why so low, why so low, why so low? Because you tell yourself you don't want the risk. So then you put it in the FD, then you have to be happy with it. So this is the risk reward trade-off. Okay. Okay. Then for the portfolio, right, you have another line. Okay, another line is called the CAL, Capital Asset Allocation Line. Capital Asset Allocation Line. Okay, this line CAL is called Capital Asset Allocation Line, or CAL. Now this CAL is a line that you originate from your y-axis. You originate from your y-axis and then you go across here. And this capital asset allocation line, on last week, I remember the lesson, I said that this capital asset allocation line is actually a line that tells you how much money you want to allocate between your risk-free and then your equity, your portfolio. Like you have 100,000. Well, out of this 100,000, how much you want to put in the risk-free asset? How much you want to put into that? So then you will draw a line. You don't draw first. I just show you first. You don't draw first. Let's say the risk-free is 5%. Is it? Start from here. Okay. So the risk-free is 5%. Let's say this is a bond. Okay. Let's say the risk-free is 3%. Okay, risk-free. Let's say the risk-free is 3% here. Okay, not 5, because 5 is the bond. Bond is a risky asset. So let's say the risk-free is 3% here. Okay, risk-free meaning that cannot be bond. Bond, there is a risk. You may lose money in the bond fund. So risk-free meaning that there's no way you will lose money one. That's risk-free. So FD is a risk-free. So let's say this 3% here is FD. So the capital asset allocation line would be a line that go all the way up. Okay. So let's say it touches here, right? So that means that you can allocate your resources, your money, either 100% into this portfolio or 100% into risk-free. If let's say you put everything into portfolio, you will get this return, 6% of return. If 100%, and then you accept this amount of risk, which is about 7 here, 7 or 8 here. You accept this amount of risk. However, you say, I don't want risk. I don't want to lose money. Then you say, okay, I put 100% into 3% of FD. Then what is my risk? 0. Then I will accept the risk that no risk at all, but I will have to accept the low risk here, which is 3%. So this one is called the capital asset allocation line. So for this capital asset allocation line, there's a formula. The formula is RF equal to which is your return, okay? Your return equal to actually your expected return equal to RF RF plus there's a this one is called the Sharpe ratio. Okay, Sharpe ratio times what's the formula? Sharpe ratio times the standard of deviation of the portfolio. Okay, Sharpe ratio. If you can recall, the Sharpe ratio is a gradient. Okay, it's a gradient. The gradient times the standard of deviation of the portfolio. So then this one is a capital asset line, which is expected return is equal to your RF plus the gradient, okay, gradient times the standard of deviation of the portfolio. So if you to bring this all together, right? So then you will have expected return minus the RF equal to S times standard of deviation of the portfolio. Okay. So if let's say you want to calculate the Sharpe ratio, then this thing you have to bring down here. Okay. So it becomes S is equal to the whole thing divided by standard of deviation of the portfolio. So therefore, the Sharpe ratio is equal to the expected return minus the RF divided by the standard of deviation of the portfolio. So in the sense that this Sharpe ratio is actually the gradient. So it will be RF 6 minus the expected return RF, ER 6 minus the RF, which is 3, divided by the standard of deviation here, which is 7. So in this case, it will be 6 minus 3 divided by 7. And that will tell you the gradient. The gradient is looking at the slope of the CAL. Okay, how you allocate your money. 你看这里是多少？这里 Yeah, because you have to touch the line. You cannot go here. You are not touching the line. You must touch the line. Because this line is the most efficient portfolio. Because if you are here, right? Okay, now let's say you are here. So when you are here, let's say you are here on 6% return. So when you are here, right, what is your standard of deviation? Is it higher? So that means you are not efficient because you got the same return, but you got the higher risk. So this position here is not efficient. Here is very efficient. So if you compare anything here, right, it's less efficient than the line here. Anything on top of the line is the most efficient one. So therefore, this line here represents all the combination of the portfolio whereby you are at the most efficient frontier, the most efficient one. So because if you are here, you will lose out because you are of a lesser return and then of a higher risk, same risk but lesser return. You are here. You've got the same risk but lower return. Over here is unattainable point. You can't attain here. You can't achieve here. So here is out of your boundary. It's unachievable. So these are the point whereby all these are achievable. All these are achievable. So when you compare to this achievable point, right, this point here will be the most efficient frontier. Okay, it's the most efficient frontier. Oh, you mean if I have another steeper line and then touches here? Yeah, can. So therefore, on this curve, right? So if let's say I want to erase this part here. So if let's say I look at this curve, right? Can you tell me which point is the most far northeast? Northeast meaning that you are on the left and then on the right. Left and right, okay? So which point here is the most far east? Is it this point or this point or this point? Which point? Because that point will be the most efficient one. If you were to here, right, you are still less efficient than this point here. Because you are of a higher risk and then of a higher return because you are of a higher risk. So this point is the most efficient because you've got the minimum risk, lower risk, the lowest risk. So, okay, so if let's say you were to compare this point is also, you know, the risk is higher actually. So actually here is the minimum risk that you can achieve. So back to the okay. So if you can see, right, that point there is called the minimum variance portfolio. It's whereby you can achieve the minimum risk. Variance means risk. It's called the minimum variance portfolio, whereby you can achieve the minimum risk. So this is a CAL that I show you just now. I proved to you the calculation, whereby the Sharpe ratio is equal to expected return minus RF divided by standard deviation. Does it always like that? The music? From where are the music? Is it always like that? No. Oh, sorry, my phone. No, this one is another phone. I hardly use it because I thought I wanted to use the Wi-Fi. Okay, never mind. Okay, so then this is the slope whereby that I showed to you just now. So the optimal risky portfolio is the best combination of risky and safe assets to form a portfolio. Okay. Now in your assignment question number 9, you are supposed to calculate all the 4 stocks. Okay. You're supposed to calculate all the 4 stocks and then calculate the mean, the variance, and the standard deviation, and also the covariance and the correlation. Then there's one part whereby you need to solve for the maximum allocation, like out of these 4 assets, right? How you want to allocate, in what percentage? In what percentage so that you can get the optimum portfolio. Just now we saw the Excel worksheet. It's like this probability is all given, like we say, okay, in this scenario, 10%, 20%, 30% change. And then what is the possible? And then we say that, okay, this point here is the possible, right? But then in your assignment, right, you are not given all this probability. You're supposed to find yourself. You're supposed to find what combination of X and Y, right, will give you the maximum portfolio. So you're supposed to draw a line. Either you can draw a line and then solve method by looking at the chart itself. That means if let's say the risk-free is here and then you draw, because the covariance is 0.2. So 0.2 is a gradient of the Sharpe ratio. So 0.2 is if let's say this is 10, this is 0.2 is 10, and then this is 20, 10, 20. So that means you are actually looking at a slope of like this. touching here. So you're looking at the slope here. And then with this slope, right, you're supposed to calculate the intersection point of the slope. This point, in this case, this point intersect with this point. Okay, let me see. Okay, the reason why I draw from here, because I know that 0.2 meaning that I have 10 divided by 20 is 0.2, is it? 10 divided by 20 is 0.2. Then 0.5, I wait, 0.2 is then 10 divided by 200, no, 10 divided by 50, so 50. So I have, until there 50. Okay, so it's very flat. Okay, so what you're supposed to do is that draw a gradient and then to see what is the point. So that tangent to the CAL line will be the optimum. Okay, so this expected return, after you have calculated the expected return, right, then you have to plug it into the formula for the expected return of the formula to calculate the weight 1 and the weight 2. So the formula is given in your slide here. So this is a formula given in your slide. It's a very long formula. Maybe I should. Maybe I should reduce it. Oh, I have to close it first. Okay, anyway, close it. So then even this is the calculating of the optimal risky portfolio, the 2 risky assets. So this is the formula. So this is for question number 9 in your assignment. Look at the formula, it's like headache already. Such a long formula. Either you use this formula, or another way I saw from the YouTube, you can use Excel worksheet to use the data solver function to solve for this one. So this one is to solve for the weight. You see the weight for the stock B and then the weight for the stock A. Once you get the weight for the stock B, then you can get the weight for the stock C. Another way of calculating what I do maybe I show you. Okay. I didn't bring it here. Maybe this other I can show you. I did for my other course. I have a 10 stock portfolio. And then you will have to use this formula. You have to use this data, and then you go to data. Is there a solver? If there's no solver, right, you need to install the pack. You need to go to the file here and then options, and then you go to add in, and then you install the analysis tool pack, and then you click OK, and then you install it. If you are using ASUS, right, then you need to troubleshoot because your ASUS inside got the WPS. It will interfere. It will not let you download. So you need to take away the WPS uninstall first. Then you can download this one if you are using ASUS. Other computers should be okay. So this one, if you do not know how to install this one, right, you can Google. Google got a lot of YouTube that teach you how to install this analysis tool pack. So you go to the file, you go to options, and then you go to add in, and then you go to analysis 2-pack, and then you click OK. Then you can install here, and then you can see solver here, data here. Then only you can click that data solver, and then come up with a pop-up window here, and then you can put the. I can show you another YouTube video that teach you the step-by-step how to do that. Okay, there are a lot of videos on teaching you how to do the solve the portfolio allocation using the Excel worksheet. Okay, so these are the way you can try first. Okay, you can try when you're doing your assignment. You try first. If you have problem, then you come back to me. Okay, I want you guys to try first. Okay. I know, very tedious. Yeah. So then, the efficient diversification many risky assets. So in this case, the graph is a representation of a set of portfolio that maximizes expected return at each level of portfolio risk. So there are three methods. You can maximize the risk premium for any given level of standard of deviation. You can minimize standard of deviation for any level of risk premium. Okay, now this maximize of the risk premium. Okay, risk premium. Okay, now risk premium means what? What do you mean by risk premium? Risk premium is your something that is excess of your risk-free rate. Okay, will be your expected return minus your risk-free rate. So that will be your risk premium. So if you are looking at the Sharpe ratio diagram, right? This one is your return, and then this one is your risk-free, correct? So this one is your return, and then this is your risk-free, correct? If you are looking at the Sharpe ratio diagram. No, risk-free is a FD rate, 2%, 3% FD rate. Okay, so just now we got 3% FD rate and then the 6% here. So this is your risk premium. So there are three methods. One is that you maximize your risk premium. The higher the risk, the better. Or you want to minimize your standard deviation. The lower the risk, the better. Or you maximize the Sharpe ratio for any standard deviation or risk premium. So you maximize your Sharpe ratio. So your Sharpe ratio is equal to R minus RF divided by standard of deviation of the portfolio. So this one is the Sharpe ratio. Maximize this Sharpe ratio. So there are three methods. So the one that the solver in the Excel or the YouTube that I'm going to give you to see, right, is the third method to maximize the Sharpe ratio. They put the solver, maximize Sharpe ratio, and then you have to click the Sharpe ratio. Like you have a column whereby you calculate the Sharpe ratio. You click the solver, and then you click that there's a column for you to fill in what you want to maximize. So then you say, okay, I want to maximize Sharpe ratio. Then you point to the Sharpe ratio, and then you click that cell. Okay, you maximize the Sharpe ratio, and then there's another column to help you to key in the variable. Variable will be the percentage of your portfolio. So you click in that percentage. So in the end, they will calculate for you what is the percentage for the 4 stocks. In what percentage? Maybe 10% stock A, 20% stock B, 40% stock C, and then the rest is stock D. Then they will have come up with the combination. Okay, so that is your assignment. You need to absorb first. Okay, I know a lot of information. Okay, a lot of formulas, a lot of information. You need to really read the chapters. Okay, you need to read the chapters and then to understand, and then also to try out the Excel worksheet. So it's not easy, right? This topic is not easy. Okay, so that's why I said in Tsinghua University, the best brain will go to the finance department. The best brain. Okay. So in this efficient frontier, you can see that the individual asset that are below or underneath that point, right, is all inefficient one. The efficient one is always on top here. Okay. Okay, so then this one is called the minimum variance portfolio. And then this is efficient frontier of risky assets. So this is all the efficient frontier. Okay, so the next one, okay, you want to take a rest now or not? Take 5 minutes break. Okay, take 5 minutes break and then we'll come back. Okay, if you have the Excel worksheet, right, try to see whether you can install the package, the what tool. You see whether you can install this one or not. Option, and then you click the add-on. See whether you can install or not. You see, just now I said your right hand side is your x-axis. So this one is your center of deviation. It's your center deviation. You see your center deviation become here already. You delete first. You delete this whole thing. And then you see and then you choose or you highlight first. Okay, then you choose the insert. Scattered. You see the first one will look better. First one. Scattered. Okay, Okay, for those of you, how you got this one, it's actually you highlight and then you go to insert, and then you go to the scattered, the last one, the scattered graph, okay? And then you click the first one, okay? Because all these are different, so you click the first one. Your standard of deviation, the standard of deviation, then you copy the value here, copy the value. 这个东西你要 copy 到那边去，因为是那个左边右边的关系，因为 x axis 永远在左边。如果你放在这里左边就变对。你要把这个放在你这边。放右边。copy value， 你要小心你要 copy value， 不然它因为你这里有 formula 在里面了的，所以你要只要 paste 那个 value 就可以了。copy 然后 paste value 是 paste 的时候要所以很多时候是 Excel worksheet 还要重新还要学这个课还要再学那个 Excel worksheet 第2还是第3然后拿这个insert 要 highlight insert then 去到那个 scattered graph 最后一个 graph 那个有一个 graph 的最后一个对，可以选第一个。它是这样子的，它就是你可以选很多个的，这个 for this 他们是选这个。有啊，有啊，没有线可能再选第2个。 它有一个是有 line， 一个是没有 line 的，等我们看出去。
然后我的问题是，好像这个是它的最好的那个最低的最高的比分啊，对，因为不然这个就。
你的那个是变的哦，因为你的，
所以可是那个 stop 现在就变成
你要找出来。
现在 OK， 现在讲是 market 是3%的3%，然后3%，然后到底刚刚讲6%就是这个啦 ，around 6%啦，然后3%是那个 risk premium 和这个 risk market risk， 这是。在这个回修的这个地方是很少。
对。
所以我们对。
所以你的答案哦，讲using the minimum， 因为它该有3个嘛，所以你讲 using the minimizing the standard deviation for any given level risk premium. So this is the best allocation.
The maximum shock ratio 不是我们 maximum shock ratio
就是 you must calculate the slope of the CAL line and then to maximize. So it could be here, you know, it could be here. Because when you use this line when you use a line it could be here. It could be here.
Line.
Yeah. So different will give you different answer. Option then 有没有add in then 那个叫什么？
不简单的这个。
Yeah. Add in the option. You add in analysis 2 pack.
这个
analysis 2 pack。
这个有 VBA 的。
没有 VBA 的。没有的。choose 它。Okay. You go to file, more, option, add in, 2 pack. Okay. Do you have WTS here? WTS. This one can you uninstall first? Or this uninstall first? Uninstall the WPS. You don't have that?